Welcome to part 2 of our course. In the previous part, we talked about how to predict the high and low of day with high accuracy. We used a concept derived from Elliott wave theory. If you haven't watched that video, check it in the description below. Today we are going to talk about how to predict the weekly high and low using the average daily range as well as the Elliott wave theory. But before we jump into the whole video, make sure to hit that subscribe button if you haven't done so. Please also check our free Telegram channel where we share free signals, trading advice, as well as support. The link is also down below. Make sure you have somewhere to take some notes so that you fully comprehend everything we will talk about. So in this part, we will talk about the weekly Elliott waves, average daily range or ADR in short, combining the Elliott waves and the ADR, then steps in predicting the high of week or low of week. You're basically wondering why we need to predict the high of week and low of week. Predicting the high of week and low and combining it with the concept of catching the high or low of the last day gives us the ability to catch sniper entries. Sniper entries will decrease the stop loss width and allow us to use higher lots, so make sure you watch till the end. So we'll talk about catching the highest point or the highest price that can be reached within the cycle. Firstly, we'll need to revisit the concept we introduced in part 1, which is a derivation of the Elliott wave theory. Then we'll talk about the average daily range. Combining these two concepts will give us an edge in finding a precise weekly reversal. So here is a Elliott waves in a weekly structure. Before we go deep, we'll need to reintroduce this theory. So the Elliott wave theory proposed the idea that market cycles actually resulted from reactions of investors to outside influences or the psychology of masses at that time. What we are basically trying to say is whatever we see on the market is a reflection of how traders are reacting to the movements of the support or the movements of the supply and demand zones. The downward and upward swings of mass psychology always had a repetitive pattern, which are termed waves. So let's see the pictorial illustration of this theory. We have this weekly structure template, and this is the template that we'll try to fix in each and every market structure we see. Failure for the market structure to fit in our template the result is to discard it. So the first thing that we need to see is to see these market flows or waves. The waves being equivalent to a period of a day. In this scenario, we have day 1, day 2, and day 3. Day 1, initiation, then termination. On its termination, that is where we see wave number 1. Then from this termination to number 2, it's a counter wave. And this can also be represented as a consolidation from this point to that point. And from this point to that point is the same manner from this point to that point. So for us to deem a structure valid, we need to see 5 waves in this scenario. 1, 2, 3, 4, and this can also be presented as a consolidation or a choppy region. Then 4 to 5, and then we expect a weekly reversal. Then from 4 to 5, that is where we now apply what we learned in part 1 to get or to anticipate high of this day in this scenario. So the above weekly structure template is the one that will follow through all the time. We'll need to see 5 waves before anticipating the weekly high or low. Each forward wave, for instance, from 4 to 5, must cover at least a period of a day. The counter wave must also cover at least half of the previous day. But in some instances, they can be presented as choppiness regions. So the highs and lows of these waves, which are basically the highs and lows of days, can be obtained from the concept we learned in part 1. Then here comes the average daily range. The ADR shows the average pip range of a currency pair over a specific period of time. The weekly high or low mostly occurs at 3 multiplied by the ADR pips. This can be done with an indicator or manually, and I actually advise you to calculate it manually, because calculating it manually will give you an edge in calculating any pair or any tradable asset. So you can calculate it manually by obtaining the number of pips of the first wave. Actually, I had to write the first wave and the second wave, add them and calculate the average. That's wave number 1, then wave number 2, add the pips, then divide by 2, and you can now anticipate for wave number 3. So ADR is important to us because the IMF restricts movement of price to extremes so as to avoid a collapse of the market. We mean the International Monetary Fund restricts market makers to push the graphs in whatever amounts they want, because that will lead to crashing of the market. For instance, they are not allowed to push GBP against US 400 to 500 pips a day, and the following day another 500 pips, because that will definitely crash the market. So every move must be backed up by a strong economic support. So with these facts in place, we would know that the ADR will hold. So this general limit to the ADR and involve moves as much as 200 pips per day in most pairs. So now let's go over the charts and learn everything, how to combine the ADR as well as the Elliott waves. Right, so this is USD against CAD, and we are going to try to fit in what we have learned. So the first thing that we need to see is a point of initiation. By point of initiation, we can simplify how we can see a point of initiation by looking at the H1 1350 crossover. That can give us a point of initiation. Then from that point of initiation, whereby we've seen 1350 crossover, we need to see 5 waves from that crossover. Anything that doesn't give us 5 waves is not of use to us. So let's take, for instance, this is H1 time frame. The first thing is we can see that here we had a 1350 crossover. So it means everywhere we had 1350 crossover from this from the past market flow, but none of those 1350 crossover gave us 5 clear waves, right? So this is for illustration's sake. That is why you are seeing it in foresight, right? So we are going to mark out. So from this point to this point becomes our first wave, and as you can see, after the first wave we had a consolidation, as I said earlier. So from this consolidation we can see that we have 1, right? We have 2 here, right? From this point to that point we have 3 at this point, and from this point we have 4. So we want to actually predict the zone of this weekly low. How do we do so? The first thing that we are going to do is we are going to measure the number of pips from the high to the low of the first day, which is 195 pips. Right, let me grab my calculator. 195 pips. Then from 2 to 3, how many pips did we have? 2 is at this point, then 3 is at this point. As you can see, we had 127, right? It's 127, right? So it's 195 for the first wave plus 127 for the second wave. Then we divide by 2. We got 322 at this point. So 322 divided by 2 is 161. So from 4 to 5, we expect to see 161. So as this day actually started, we wanted to anticipate or to predict this region, which is the low of this week. So we are going to put, this was the high, whereby we had 4 and the market was in play at this point. So this is 1.2415, 1.2415, then minus 161 pips. So this is 1.2415 minus 161 pips, an average drop that we got from these two drops, and our price will be 1.2256. I hope you can calculate some pips. That's 1.2256. This is the zone that we expected to see the market reversing. As you can see at this point in this region, that is where we saw the market actually making a reversal. So let's have another example. Right, this is CAD against CHF, and as you can see, the first thing that we need to do is to look for 1350 crossover and see 5 waves coming after that 1350 crossover. Then wait and anticipate for the weekly high or weekly low. As you can see, CADCHF from this point to that point, we had clear waves. I hope you are understanding. If you are not understanding this, please don't hesitate to ask questions in the comment section. So from this point, we had the first wave. As you can see, we had 1, right? Then 2, then 3, 4, and 5. So this actually was a valid structure or a valid template of the Elliott wave that because we had a 1350 crossover and 5 waves after that 1350 crossover. So what we are going to do is we are going to look back to backtest if we were going to manage to predict the last the weekly low. So from this point we can see that wave number 1 had 61 pips. It had 61 pips. Then wave number 2 had how many pips? 73 pips, right? 61 from wave 1, then plus 73 from wave 2, we get 134 pips. So 134 pips divided by 2 is 67 pips. So this was the high that was set, and while it was in play, we had to anticipate or predict this zone. So 67 pips, that is the ADR that we obtained from these 2 days. So we are going to subtract the 67 pips for a drop from this price, which is 0.73 13.24. So subtracting 67 pips from this price will give us 0.7357. Let me mark it out. It's 0.7357, right? Sorry, it's 0.7257, right? As you can see, we managed to predict this was the low, and on that, it's either we could wait for a setup or whatever, but we enter opposite to the market flow whenever we get the low of the market. Then yesterday, I gave out a signal, right? After I saw that there was a 1350 crossover here, which is 1, 2, right? Sorry, it's 1, then 2, 3, 4, and from 4 we went to 5, right? And how I got to make a sell here from this point to that is we had the first wave had 102 pips, 102, plus then the second wave had from this point to there, that point, it's 78 pips, right, which is 180. Both these waves have 180. So dividing by 2 to obtain the last length, we get 90 pips. So from this point, we are now adding 90 pips to 0.7358. So adding 90 pips to this price, we will get 0.7448, right? And as you can see, this is the level that we had, which was a region, and I saw a pattern within this region. So basically, that is what you will be doing. The first thing is to make sure that you see a 1350 crossover on that H1 time frame. After seeing a 1350 crossover, you have to see at least wave number 1, number 2, number 3, and number 4, so that you'll be able to calculate the ADR of the anticipated peaks from number 4 to number 5. Then after that, you would see the market going to number 5, and at number 5, it's up to you to enter directly after a setup presents, or whenever the price touches that price. So for you to gain enough experience with this concept, you need to backtest a lot. Try to find the 1350 crossover, try to find waves number 1 to 4, then anticipate where number 5 was going to be. We come to the end of this video, and if it has helped you, please consider sharing it with someone.